All right, Trump's new tax plan was just signed into law. And look, if you make any amount of money, this is something you need to understand. These changes are massive, and whether you're working hourly, self-employed, or planning for retirement, the rules of the game have just changed, and it's going to affect how you earn, spend, save, and file your taxes. Quick intro, if we haven't met, I'm Kareem Taloon, a certified financial planner and founder of KT Wealth Management. I work with individuals, families, business owners to help them retire with confidence through smart, tax-efficient financial planning. All right, quick heads up. Researching this bill was honestly pretty frustrating. Every article out there is either this steals from the poor or this is the best thing for America. So this channel, we're not political. We're just here to give you the facts so you can make smart, informed money moves. And if you appreciate that, just take 2 seconds, hit the like button, subscribe. It helps more than you think. It means the world to us and keeps the content rolling. All right, let's dive in. So how we got here? Back in 2017, Trump signed the Tax Cuts and Jobs Act. That law lowered individual tax rates across the board. It dropped the corporate tax rate from 35% to 21%. It created major write-offs for small business owners. And it capped the SALT deduction at $10,000. But many of those changes were temporary, and they were set to expire at the end of this year, 2025. Now with this new bill, the One Big Beautiful Bill Act, not only are those tax cuts extended, but new rules have been added, and some of them are pretty surprising. All right, so let's go through some of the changes. No taxes on tips or overtime. If you earn tips or work overtime, this is pretty big. You can now deduct up to $25,000 in tip income or up to $12,500 in overtime pay. And if you are married filing jointly, you can deduct the full $25,000 combined. It starts phasing out if you make over $150,000 as a single filer or $300,000 as a joint filer. It's available through the end of 2028. So if you're a waiter, driver, nurse, this could save you hundreds per year, not thousands. All right, number 2, the SALT deduction bump. This one's especially important for people in high-tax states like New York, Cali, New Jersey. Before 2018, you could deduct all of your state and local income taxes and property taxes, but the 2017 law capped that at $10,000. Now the new bill temporarily raises the SALT deduction cap to $40,000 starting in 2025 with 1% bumps each year through 2029, and it reverts back to $10,000 in 2030. Phases out for income earners above $500,000, and it's a major win for upper middle class households in high tax states. This can mean thousands in extra deductions. Number 3, tax rates stay lower. Current tax rates, 12%, run to 37%, will remain as they are and will adjust with inflation through 2029. That means the top rate won't revert to 39.6, will stay 37. Most income earners will keep paying less than they would have if the 2017 cuts expired. Number 4, mortgage interest deduction. This stays in place. You could still deduct the interest on mortgage loans up to $750,000. For example, if you have a $500,000 mortgage and you're paying 6% interest, that's about $30,000 in mortgage interest you could write off. Number 5, the bonus depreciation is permanent, 100%. This one's huge for high income earners and business owners under this new law. 100% bonus depreciation. That means businesses can immediately deduct the full cost of qualifying purchases like work trucks over 6,000 pounds, equipment, even real estate improvements. Yes, planes too. This is a powerful tax shield for those investing in their businesses. All right, number 6, standard deduction increase. So most people benefit from this. Starting in 2025, the standard deduction goes up from $15,000 to $15,750 for single filers and from $30,000 to $31,500 for joint filers. And it will be indexed for inflation going forward. Number 7, 20% QBI deduction, qualified business income returns. So if you're self-employed or own a business structured as an LLC or an S-Corp, the 20% qualified business income deduction is back. This lets you deduct 20% of your business income before taxes. So for pass-through businesses, this is a big deal. Number 8, there's a $2,000 1099 reporting threshold. This is one a lot of people will appreciate. Before, if you paid someone over $600, you had to issue a 1099, get their tax information, send it to the IRS. That's a lot of work for small jobs. Now that threshold has been raised to $2,000, reducing paperwork for people who occasionally hire contractors or pay for odd jobs. Number 9, car loan interest deduction. Here's a new one. If you finance a car that's made in the USA, you can now deduct up to $10,000 per year in car loan interest on top of your standard deduction. This is available for people earning up to $100,000 single or $200,000 joint, and it phases out above that and it runs through 2028. Number 10, $6,000 senior tax deduction. Although Trump campaigned on not taxing Social Security at all, that didn't fully happen. It was harder than expected, but instead seniors 65 plus get a $6,000 bonus deduction from 2025 to 2028. This phases out if income is above $75,000 single, $150,000 joint, but for many, it could significantly reduce or eliminate taxes on Social Security income. Number 11, $1,000 Trump accounts for newborns. Children born between 2025 and 2028 will receive $1,000 government-funded savings account nicknamed the Trump account. It grows tax-deferred and can be used for college, first-time home, or qualifying expenses. So what's the price tag? This bill, it's estimated to cost about $2.9 trillion, a massive addition to the national debt. Supporters argue it'll stimulate the economy, help businesses grow, and expand the tax base. Critics say this kind of spending is reckless, passes the burden on to future generations. There's also controversy around Medicaid cuts. The new law adds work requirements for certain recipients. Proponents say it'll reduce abuse and encourage able-bodied adults to enter the workforce. Opponents argue it'll cause low-income individuals with unstable employment to lose coverage, creating unnecessarily harm for vulnerable families. Look, this bill is divisive without a doubt. But as a financial advisor, I'll tell you this. Financial literacy starts with knowing the rules. And this new law changes a lot of them. So whether you stand to benefit or not, now is the time to get organized. Review your tax strategy, talk to your CPA or financial advisor, and make sure you are positioning yourself the right way. So if you found this video helpful, like, subscribe, please drop a comment. Let me know which part of the bill surprised you the most or how it could impact your family. Thank you for watching, and we'll catch you on the next Smart Money Moves.